Previously on Audit Antics. The cast was surprised to learn that the federal government had released the draft of its Corporate Law Economic Reform Program, Audit Reform and Corporate Disclosure Act 2004, otherwise known as the CLERP 9 Act. Everyone had something to say about the imposition of mandatory audit partner rotation.
I'm very happy to present CLERP 9 to the country, with assurance that the implementation of this reform will amend the Corporations Act. Following the colossal corporate collapse of HIH, it's clear that user confidence in financial reports has been diminished, with uncertainty reigning over whether auditors can be truly independent. It's clear that business has been able to govern itself for too long, and now corporate governance is the only answer to ensure that auditors' reports can be trusted. In developing this draft legislation, we've taken into account the findings from both the HIH Royal Commission and the Ramsay Report. We believe that imposing mandatory 5-year audit partner rotations with a 2-year cooling off period afterwards is key to ensure the familiarity and self-interest threats are combated and that ongoing confidence is retained in our capital markets.
As one of the larger audit firms, we are not especially troubled by the implementation of the mandatory 5-year audit partner rotations, as we have a vast staff pool of talented individuals, each capable of shadowing the current audit partner and stepping up to run the audit themselves when the time comes. Indeed, we've already been conducting ourselves in a similar fashion to date. That said, it is impossible to prevent some loss of client knowledge when rotation occurs, with extra care and consideration necessary for our bigger ASX 50 clients, whose companies are larger and more complex than most. In these cases, it can be extremely difficult for new audit partners to develop the necessary technical expertise needed to complete a quality, sound audit. Honestly, a disproportionate period of time is spent by auditors preparing to take on the leading role in these aforementioned clients. It really does seem costly, both for us and the clients. It seems a bit like a cookie cutter approach, which doesn't quite hit the mark, and really some consideration should be made on a case-by-case basis to ensure that it doesn't negatively impact on our ability to provide a sound audit. This is important not just for our firm, nor for our customers, but for the continuing credibility of audits and the confidence they inspire in users of financial reports.
I'm a little worried about what mandatory audit partner rotation will mean for my firm. We end up losing clients just because we might not have enough staff pool to cater for rotating every 5 years. Given that the new audit partner on an engagement will lead to spend extra time in the first year or two at least getting familiar with the specific of the company, it seems likely that we will have to increase our price too. Has the government given the potential for the exception any thought? This seems like it could be quite problematic for us, and we don't want to lose our credibility by potentially dropping the quality of our audits.
I have mixed feeling about the new mandatory audit partner rotation. On the one hand, it's be good to have a fresh set of eyes look at our account. This will definitely increase the credibility of our financial reports in the eyes of users, as any perceived threat to independence will be neutralized. On the other hand, I'm concerned about the possibility of a reduced quality of audit work as the result of a loss of industry-specific knowledge. I'm worried that we will really feel the loss of an outgoing audit partner. I'm also concerned that the extra time the income audit partner will spend familiar themselves with my business will increase audit price. But will this increased price translate to an equivalent level of benefit? I'm not so sure.
Think back to the days of Arthur Andersen and Enron. I read that Andersen auditors set up permanent office in Enron's main building, were wearing business casual and were indistinguishable from Enron employees. Then there was HIH scandal that happened here. This thing seems to have tendency to repeat if legislators do nothing to remedy the situation. I am very happy that mandatory rotation has been introduced. Hopefully this will tackle the threat of familiarity and self-interest to the auditor independence. From my perspective, anything that further contributes to the upholding of the core principles of audit process in a step in right direction. I want to be able to rely on integrity and truthfulness of the company's financial statement to help me best allocate my scarce resources.
It has now been more than 12 years since CLERP 9 came into effect on July 1st, 2004. We now seek to catch up with our cast to see how they've been dealing with the changes.
Well, let me tell you, I'm pretty pleased how the CLERP 9 amendments panned out. In case you didn't know, the key statutory provision laying down the line on audit partner rotation is Section 324DA, Division 5 of Part 2M.4 of the Corporations Act. Monroe and Hussein's 2013 paper, Does Audit Quality Improve After the Implementation of Mandatory Audit Partner Rotation?, found that the legislation we passed served its purpose in providing improved quality of audits. There has been a little bit of animosity from suppliers and purchasers of audits with regards to the unfair and unreasonable nature of a blanket 5-year audit partner rotation rule. We've listened, and in 2012 we put forward and passed the Corporations Legislation Amendment Audit Enhancement Bill. In effect, this provides an extension of 2 years to the general 5-year audit partner rotation rule if specific approval is granted by the Audit Committee. This approval can be sought if the shorter period reduces the quality of the audit, as can be the case in some specialty industries.
I can hardly believe it has been 12 years since we filmed the first installment of Audit Antics. Gee, time flies. Our firm has actually been able to implement the mandatory audit partner rotation with a high degree of smoothness. This has been as the result of ensuring adequate interaction between incoming and outgoing audit partners to keep knowledge of our clients' businesses at a high standard. Contrary to earlier belief, we've been able to implement the mandatory rotation without the need to raise the costs passed on to clients. This is due in part to our good planning, but also due to our access to a global network and audit partners with industry experience. That said, we're happy that where necessary we can apply to the Audit Committee for an extension of up to 2 years for an audit partner's tenure on an audit engagement with a listed client. This reduces some of the burden in auditing some of the more complicated big clients. That said, I'm concerned about the conflicting reports regarding audit quality, as some have indicated an increase in audit quality since the introduction of mandatory rotation, whilst others have actually suggested that audit quality has deteriorated. It seems prudent for further research to be undertaken in this area to weigh up the cost-benefit of having the rotation in place.
We've had to raise our price for audit engagements, especially for large complex clients, like for example, banks for whom incoming audit partners needs to spend extra time getting to know the business and industry and quantity enough to ensure that they can have an opinion of no material misstatement being present in the financial reports. The literature in the field reflects the issue had by the firms like ours, who have been particularly burdened by the mandatory rotation. The government introducing a system to apply for extra 2 years for the audit partners to be engaged on the audit is definitely a step in the right direction. But what I'd like to see is some conclusive evidence showing that this mandatory rotation provides any benefits, either by the way of user confident or improve audit quality.
I can only say that the 5 years audit partner rotation have not had a negative impact on my technology company, Banana Limited. In fact, we have had strong growth and have added many leaves to the company tree. Throughout this growth period, the transition from the outgoing to incoming audit partner has been far easier than expected. They seem to have communicated among themselves without needing to burden us with a lot of inquiries. At first, I felt this change was bananas, but now I think it's grapes. Oh, I mean great. We also have not had an increase in audit price. However, other companies with non-Big Four auditors have said that they have been price increase. Given that the purpose of the imposition of mandatory rotation was looked at from the perspective of ensuring auditor independence, I do wonder if the change has had an impact, positive or negative, on audit quality.
When the law was introduced, I was extremely supportive but worried about audit quality. Recent research has eased my concern. It was found that with partner tenure longer than 5 years, auditors were more likely to consider clients to be going concern, even if the company was in financial distress. Whereas if partner tenure was shorter than 5 years, they were more likely to qualify their opinion. They also found an increase in audit quality with the reduction of audit partner tenure. These are exactly the changes that I wanted to see after the introduction of this legislation. I think the users have significantly benefited from the introduction of Club 9, and I'm glad that the government has successfully stepped to protect the users.
Today, the cast of Audit Antics meets for the first time to discuss their thoughts on mandatory audit partner rotation moving into the future.
We're quite pleased with the outcomes of the introduction of the mandatory audit partner rotation. There have been many reports of improved audit quality following the audit partner rotation, and the changes obviously had positive impacts in relation to auditor independence. Another consideration that has been floating around is the mandatory rotation of audit firms. Some studies have suggested that this option has a negative correlation with audit quality. This may be due to the fact that when audit partners are rotated, there is still a level of conservation of knowledge within the firm, whereas this would be lost with audit firm rotation. There has also been strong opposition to mandatory firm rotation by both suppliers and purchasers of this, and for this and other reasons. Many studies have conflicting results, and generally it's difficult to reconcile the theoretical benefits of audit firm rotation with the research findings. This means that more robust research needs to be done. This also applies to audit partner rotation, where some parties have raised concerns as to whether partner tenure with a particular client was actually the main issue when it came to cases like HIH and Enron. They suggest that more conclusive research needs to be done as to whether partner rotation is the best possible solution to the issue of auditor independence in these cases before we make any decisions.
One of my main concerns previously were that we may incur increased audit fees due to mandatory partner rotation. Thankfully, this wasn't an issue for us, and some research suggests the Big Four clients such as ourselves haven't been significantly affected in terms of auditor fees. Interestingly, other studies have found that during the immediately after partner rotation, audit fees are higher for big multinationals, which I found concerning. Thankfully, Banana Limited has not been affected in such a way. It is confusing as to why these conflicting reports have come about, but clearly it's important for more research to be done in this area.
That's so interesting, Will. We're of the opinion that larger multinational firms and large auditors should be able to bear the burden of this legislation. We've added provisions in special circumstances for the extension of the rotation period in case there's unreasonable burden, but I do agree that more research needs to be done.
All I care about is that audit quality goes up.
Hear, hear.
I think it's important for us not to lose sight of the fact that our audit partner rotation obligations are not limited to the 5-year rule for listed companies stipulated in the Corporations Act. We are also bound by the APSB's Code of Ethics for Professional Accountants, such that 7-year audit partner rotation is needed for public interest entities. This definition is considerably wider, including listed companies, of course, companies who are required to have audits either as the result of legislation or regulation, and companies that may have a large number and variety of stakeholders. Perhaps a comparison could be made between the quality of audits for listed companies and the quality of audits for those public interest entities that are not listed in order to compare whether rotating 2 years earlier adds any value to our audit reports. At the end of the day, I really just think more research is needed.
Well, as I've said, we've had to up our price and have been severely disadvantaged by the audit partner rotation legislation. Well, I understand that the confidence of users of financial reports is crucial for the capital market retaining in good shape. I generally don't think a one-size-fits-all approach is the best possible answer. In the meantime, we will keep on keeping on and just deal with the legislation. There's not much else we can do when it comes to this sort of corporate governance.
The Audit Antics cast have made it clear that more research is needed to conclusively prove that mandatory audit partner rotation provides enough benefit to make it worth the cost of implementing. That's the end of the show for tonight. Please visit our website auditantics.com.au for exclusive access to behind the scenes goodies and to tell us what you thought of tonight's episode. Good night, Australia!